All right, well, after what seemed like a relentless streak to the downside of losses, for especially the NASDAQ composite, we reversed that today. So we finally had a good, strong up day. The question always, whenever we get a 1% up day or 2% up day, and we came pretty close to 2 today, is, the question that invariably gets asked is the low in. If we hit the low, are we done? Are we bouncing up? Are we going to new highs? Are we going to get to new highs by the end of the year? So that is always a question. So the question is, did today's move change any expectations we had from our last video? So I'm going to break that down today to see just how bullish we were and how much it does change those expectations, if at all. We'll talk about what's driving. There's some pretty major moves going today, especially in the dollar and especially in bonds. We'll take a look at how major those were from their trend when you zoom out on their trends and the implication that has for what our expectations are going forward. And then finally, we'll take a look at a trade idea on a bellwether stock that had a big day today, and we'll talk about how to trade it, kind of as a proxy for the whole market. So let's go ahead and get started. Today is Wednesday, September the 7th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. And before we get started, I invite you to subscribe to our YouTube channel with that icon right here, or the subscribe button down below the video. Click that thumbs up icon to like our video. Comment down there anything that stood out to you. Join our website at MarketScholars.com with that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, come over here and check out some of these things over on the right, as well as you can come down to the bottom, click on that heart, it opens up this tab, hit that like button. Same thing here with this thumbs up icon, click on that, hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those social media platforms. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we came down to this 23% line yesterday. It got a cluster there, and not only that, but if you look at, if you draw a Fibonacci line, so these Fibonacci lines, the green and the brown, are based off the declines, retracements of the declines. If you look at this latest pullback as a retracement of this rally, this retracement here, this pullback is a retracement of this rally, you notice we came right, not only did we come down to that orange 23% line, which is important support, but we also came down to this 62% retracement of the rally. So there's some, again, with a cluster, so multiple supports in this area with that cluster there. So very important, as we talked about in my directional option strategies class yesterday on Market Scholars. We talked about, hey, this is it, there's support here. We either bounce here or we don't. But if we're going to bounce, if we're going to be bullish, we've got to bounce here. So that the beauty of a situation like that is you can be pretty bullish there, knowing that, okay, if it doesn't work, your risk is really small because you'll know really quickly. But if it bounces here, then you're about as close to your support as you're ever going to be, at least to your stop order, which is usually below support. So you can get a really, really good reward to risk ratio there. And that's, that was the case today. Today we had a nearly 2% rally. Now keep in mind that, during these declines right here, so we had, this decline from March 29th, started March 30th down to June 16th, right? So March 30th down to June 16th. If you look at that period, so here's March 30th, so that's the last bullish day. This is the first day of the decline, March 30th. All the way to June 16th, which is this day, this big down day. So there's your bullish periods, in here. So if I were to draw kind of like this would be right. Here is the bullish period. It ends right there. So there's that bearish leg lower, and everything inside there is the bearish leg lower. So if you look at during this period, you had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, pretty much 11, 12 days during that entire run that you gained more than 1%. And of those 12 times, 1, 2, 3, 4, 5, 6 times you gain almost 7. you gain 2%. And then, of course, one of those times you gain 3%. So just because you're in a bearish leg to the downside doesn't mean you're not going to have up days. And it doesn't mean you're not going to have really good up days. And that's essentially what we've had, because we started this decline now. So let me get rid of this drawing. If you go back to when we started this leg lower, it started on August 17th. So let's come back here to August the 17th. So that would be right here. So it starts, you draw that line here. Let me come back here, and it'd be this day. So here's the current leg to the downside, and you can see this is actually our second up day of 1%. We've already had a day to the upside of 1%, and that was it. And you can see all these other times were pretty much it too. We did have, a 2-day in a row streak of 1%. Before falling down, but mostly it was just a one-off day. Every time we had 1%, that was it. And so we'll see if that ends up being the case again, where, okay, we had a 1% move to the upside, and that was it. Of course, when you are bullish, so going back, now to kind of this mid-June period, June 15th, or kind of more like June 17th, June 21st. So in this period here, all the way up to that June 16th, so it'd be right here. Here's your period there of the bullish run, and you can see you do get multiple 1% moves. You had 3 in a row right there. You had 2 out of 3 there. You had 2 out of 3, 3 out of 5 there. 2 out of 4. You had 1, 2, 3 out of 7, almost 4 out of 7. So you do get the big consecutive moves to the upside when you're in the bullish moves. So really important to see that we follow through with this, because if we don't, then we've seen this play out before, right? We've seen good strong moves to the upside during the declines. And as of right now, that's kind of what we're getting, right? Again, we got the cluster, and the intermediate line actually dropped to the 11th percentile. Remember, getting below the 10th percentile is actually really low for the intermediate line, and so that would be a good sign. Now, short-term sentiment's bouncing. The near-term line will most likely, again, barring a big drop tomorrow, will most likely make its way into bullish territory tomorrow. It's more lagging, but it typically follows the red line up, and the red line's already there. So you'd expect the near-term line will get there too, again, barring a significant drop there. You are still 3.5% below the 30-day moving average, so we're below that 2.5% mark still. You have to, because we dropped below it, we have to get back above the 2.5% mark to the upside to change the trend around. Of course, we also need to get the intermediate line up above 60 and to change that around too. At least get it up above its market sentiment line, which is rising. So that's, and all the market forecast charts appear very similar. If you take a look at the weekly candle, it's kind of interesting. It is a lower close on the weekly chart. If you'll notice, the PPO is still kind of negative. We're still in this death cross environment, still the red arrow. Still a pretty bearish candle on a weekly basis. But I wanted to show you the whole too. If you look at the whole moving average, what's fascinating about this is when you look at other periods of time where we've really broken, we've come off of correction lows, like potentially this was here in mid-June. When we've really kind of changed things around and gotten positive. You notice, if you look down here at the bottom, let me change that whole to a 20-day whole, 200-day. When we get above 0 on there, so when the 20-day gets above the 200, it typically stays above there for multiple months, multiple expiration cycles before it even tests it. But even when it comes below it to test, by the time you turn, by the time it rallies, it gets all the way up back above the 200 before it turns red again. And then again, it gets all the way back above the 200 before it turns red. So it doesn't turn red while you're still below the 200-day moving average. You saw that over here in 2018 as well. You got the 20-day cross above the 200, so this green line crosses 0, and it stayed there for multiple expiration cycles. When we did pull back down, by the time we turned green, it turned red again, we were back above it. So again, we're not turning down. The only time really we did that was in 15 and 16 when we kind of had that double correction there. And of course, when you look at 2008, which is a common analog to this, you can see when we did get up there to the 200-day haul, we didn't get through it. We came back down below it. The other interesting thing is look at this chart on a weekly basis. According to this, like, we haven't even turned bearish yet, right? Because there's three signals you look for. One is the bearish candles, which we're obviously getting. We saw that on the other chart. Two is the parabolic SAR flips to the upside. That hasn't happened yet. And three is the hull turns red. That hasn't happened yet. So we've gotten this bearish turn, kind of like, it's kind of like these 2 weeks here, where the third week we finally did flip it around and turn the hull down. We haven't had that yet here. So that kind of goes to show, as bearish as we've been, we haven't been as bearish as we probably think that we were. We had been so bullish here that we haven't turned things back around to the downside. And you can see the MACD between the 20 and the 200, the histogram's already rolling over too. That doesn't mean we have to go down, because you can see it rolled over there as we continued higher. But we need to get that 20-day to cross above the 200 as well, like it did in 2020, like it did in coming out the fourth quarter 2018. And you notice that that's not even close to happening right now. And of course, we have to stay above it for it to actually do that. We kind of have to stay above it, and we're threatening. We've been easily below it, and we're threatening with actually turning it back down, turning it red again. So interesting pattern there. Of course, when you look at the 3 red arrow, 3 green arrow chart, we're still got 3 red arrows across the board. The MACD histogram's rising all across the board, so we're close to getting a green arrow on the MACD at least, if not the moving average. But we don't even have one yet, so we're still got light pink shading. Remember, when you're bearish like this, getting 3 green arrows is actually a bearish signal. Getting 1 day of no shading at all doesn't change things around, not until you get the 3 green arrows, and then it sticks, right? You get multiple days of the green shading back there. Looking at this chart, today's rally didn't even get us back above the 8-day moving average. I mean, as good as it was, it's a good move. The histogram's rising, but the MACD is still below its move. The MACD is finally rising again, but it's still below its moving average. It hasn't crossed above its moving average yet. That's when the histogram crosses. And obviously, we're still easily below the 8, especially the 17, and that's the important one, because that's the second number in your MACD down here. Your stochastics is turned up, but the average is still down there. If you look at where we are here, I mean, yes, we're above 20, but remember, for this to turn things around, that blue line has to get above the orange line. It has to get at least above 60, but it's got to also get above that orange line for the trend to change. Otherwise, again, we've seen plenty of 1% to 2% moves during legs to the downside. We saw it over here, and we saw it over here too. And so far today, it has the makings of one just like that. You can see from an RSI perspective, we are back above 40, but we're not into the upper half of the chart, much less above 60. We are back above minus 100, but we're not above 0 into the upper half of the chart, much less back above positive 100. So it's great, but it needs more follow through than just the 1 day for us to say, oh, things have changed, right? I'm not going to be like, like on TV where every up day is like, the discussion becomes, have we set the low point, and every down day is, are we going to retest the lows, right? It's, we're still bearish. We're still on a bearish leg to the downside, and today, as great as today was, still hasn't changed that. When you look at today's intraday move, let's take a look at today's intraday move here. You can see, well, let's say there's a few other oscillators we didn't look at. We didn't look at the DMI. You can see the positive indicator still doesn't drop back below 25. You see it drops below 25 when you turn things around to the upside, so that hasn't happened yet. And of course, the positive indicator has to get above 25, and that hasn't happened yet either. So we're missing there. The Ichimoku cloud, we actually still have a weak bearish trend, but a bearish trend nonetheless. And we did get back above the green shading, but the red line is still not above the price, and it's going to have a hard time getting above the price. I mean, we'd have to be really, really bullish to get the red line back above the price, and that's not happening either. So, we're still we're not above the green or the blue lines. We're barely above the cloud. Like, we're in danger of actually getting back below the cloud, which is not good. You should be above the green cloud by the time it turns green, not back below it. And again, you can see we're flirting with that here. And then finally, looking at the Bollinger Bands, we are not in the lowest quartile anymore. The bandwidth is pretty high. It's it's only 3 other times it's been higher on a bearish move. This is the one. Here's another leg, and then there's that leg. So this would be the 4th highest leg lower to the downside. And of course, we'd have to get at least above the midpoint of the chart, if not above 75, to end this run, like we did here and like we did over here. And that hasn't happened yet either. So nothing here today screams that we are done with the declines. Obviously, we did get a higher high and a higher low. When you look at the actual high, there's kind of that anomaly there. The actual high is right about where my cursor is. So obviously, we closed above that level, and we did get a slightly higher low. It was barely higher than last week's low point, but easily higher than yesterday's low point. So higher high and a higher low, but we're not clear. We're not getting through this level yet. So let's see if we can't get through these highs and get through this area of volume, of a gap in volume. See, there's a little bit of a resistance here in volume. So far, that's held. So if we can break through and get closer to 410, now we're talking about things kind of turning around and staying bullish and coming off of what would be a higher low point, right? This would be a really good higher low point if we are able to hold this and get back up above, probably up into this kind of 4150 area or higher to really solidify the bounce. Looking at the today's volume and range, when you look at today's volume, is at 70 million. The range was 8.39 points. So when you put those numbers into context, 8.39 is still above the average. Again, being above the average is not bullish, right? That bringing this line up is not bullish, and 70 some odd million is the same thing. It's not really bullish. It's not bearish. It's not bearish either because we rallied. But you want to, when we're rallying, we want to start bringing these lines down, not up. We want to bring this blue line back below 1% and not up. And 8.139 is actually well above, this level of, it's right about it. The average here is 6.74, so the comparing that to the price, we're at 1.74. Well, today was 8.39, so that's actually above that number. So we want to be 1% right now is below 4 points, so we need to have moves to the upside with ranges below 4 points if we're going to start bringing this back down, right, and be bullish. Finally, the volatility is dropping, not surprising. It dropped down after opening above, up above 100% on Friday. We closed down again. We have shown you in the past that that's a pretty bearish candle, especially if you open above 105. But opening above 100 is kind of a little bit of a weaker, but still bearish signal for volatility, and that's been the case as we've continued to roll to the downside. And you can see the VIX here is kind of at that point where it might turn too, and if it turns and both these turn lower, then of course that would coincide with the market itself bouncing. So I don't lean that direction. I still lean towards that we are on a leg to the downside, and today is just like we've seen before, plenty of 1-2% rallies to the upside while we're still maintaining bearish runs. Of course, we follow through tomorrow with another good strong up day. Then we can feel pretty good about potentially starting a new intermediate run to the upside that might last 1 to 3 months, right? A good long normal run, because we'd be coming off of a higher low point and be looking at starting, getting the market sentiment up into bullish territory as well, like starting an actual long-term market sentiment run. So lots of good opportunities here if we can hold the rally. But so far the indicators don't suggest the likelihood of us doing that. It seems more of just one of those really good bullish days that ultimately gets sold off until the leg to the downside is over with. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at suggest why you're either a lot more bullish than that or a lot more bearish than that? All right, now let's take a look at what's driving a lot of the price action. You can see the rally that we had here in equities over the past 3 months, the 3-month chart. The rally that we had in the equities here, this entire 3-month period, the dollar's been bullish, and this entire 3-month period, commodities have been bearish. Remember, commodities have been bullish along with the dollar for most of this year, this pattern of weakness. That's not been the case during this recent pattern of weakness. It's actually, you can see the commodities have taken a big, big leg lower to the downside. If you just look at today alone to see how things performed just today, you'll notice that real estate was up. So Qs and IWM both up together, but bonds were up, and that's not typical for bonds to be rallying this much during a strong bout of risk appetite, right? When you see the Qs and IWM up here too, and you can see corporate bonds too, just really doing well relative to like global bonds, for example, down here, and of course commodities down big, and that's one of the main drivers is the drop in crude oil today. Commodities really coming down hard, and then the dollar was down big today, and so when you take a look at those moves. Commodities have been trying to get back above the 50-day moving average, but in the past week have gone from being easily above the 50 and above the 8 and 17, and they were both crossing the 50, to now they're both crossing back below both the 50 and the 30, and the commodities have broken below the 200-day moving average. Today is the first close for commodities below the 200-day moving average in a very, very long time, right? If you go out a little bit further, since that close right there, that brief close below in October 2020 was the last time we've closed below the 200-day moving average after getting above it there in August of 2020. So brief little periods there, but so it's been nearly 2 years since we've had a single day close below, and of course you can see the MACD is negative there and falling, and from a long-term perspective, you can see that we are breaking below that 50% retracement, which has been a line in the sand for the last few months. We've gone through that line only to bounce right back up. So now it's even like if we don't bounce back up, you can see the gap in volume here to the downside. So it can really get going down to 23.5, if not down to 21.5, which would be that 2021. Fall peak down to that 78% Fibonacci level. So that's that would be bullish for equities. At least it's been the fact that commodities have been so bullish has been bearish for equities for most of this year. So really dropping down would help risk appetite, right? It'd help soften that inflation story. It would also help if the dollar came back down. But of course, that's kind of hard for those two to kind of go together. Yes, commodities and the dollar have rallied for most of this year, but generally speaking, when the dollar falls, these commodities that are priced in dollars typically rise. And so, the dollar got this tremendous engulfing pattern today, but still above the 8-day, and the MACD and stochastics are still pretty high and positive. So there's an opportunity here for the dollar to make some noise and turn down and break down here, but not, it hasn't done it yet. After kind of gapping up, potentially a little bit of an engulfing pattern. And then when you look at the long-term bonds, I mean, that was their rally today, and that kind of puts in perspective, I mean, just how bearish they are, long-term bonds are right now, but also, what we can, how much more bearish they can get. So MACD is looking to cross back below on the weekly chart here, back below its moving average. Stochastics already haven't been broken below, and now outside of the 5-week value area to the downside. So I mean, there is some opportunity here for some kind of like divergent pattern to develop here. Let me go to a weekly chart. Divergent pattern to develop now that we're already to a lower low, and we're most likely not going to break below 30 here on this low point. So I would think that right now you are more than likely in a divergent pattern here, long term, with the MACD kind of just barely at its moving average and us being below. But we'll see. We'll see if we end up extending more to the downside. That's the 5-year chart. If you look at a 10-year chart of TLT, again, you're also below the 10-year value area. I mean, that's how bearish we are. We haven't been below the value area for so long. that to get below it's pretty significant. There's just not very much volume, not very much past history. Last time we were down here was the end of 2013 when we were on that strong QE3 fueled rally to the upside. And we're not getting QE right now. So the other way that's driving this risk appetite, right? This bearishness in bonds. It's the inflation story, and we're actually getting quantitative tightening, which you can see in 2018 also put pressure on bond prices when that quantitative tightening started. Let's take a quick look at how the sectors have performed. Let's pull up the sector comparison chart today and see if we can glean anything from that. So just looking at today alone, you have materials but not energy, you have discretionary but not technology or communication services, and then you have utilities. So not really the three leaders that you'd expect to lead us to the upside. Of course, most everything was up today. It was pretty broad. Like there wasn't any kind of laggards except for energy, and energy has just been so bullish. When you look at its 12 grid, it had been the only one that was still dark green shading a green line. Now it's light pink shading in a green line now that we're falling and about to fall out of bullish territory. And you still have a lot of dark pink shadings all across the board here. The only one, again, that's back to light green shading in the green line is utilities. And when that's your leader, that's not exactly the best leadership. In fact, these three right here are all your leaders today. Materials is still below its moving average, and so is discretionary. So not quite the turnaround, like I said, not the leadership you would want to see during a broad market rally. All right, before we wrap it up for today, I want to take a look at Apple. Apple had its Apple event today and issued their new iPhones and iWatches and AirPods. And Apple is pretty much looking almost exactly like the broad market. Did not get the cluster, but you can see the bullish divergence in the near-term line with the lower lows that we've been getting. We haven't got the red line, so we haven't turned over that. The moving average is actually still rising, with us being more than 5% below it. That's getting it to fall is what turns it red. So we're not necessarily bullish here, but we're also not quite that bearish either. When you look at its long-term chart here, again, very similar to the broader market itself. Got the red arrow on the moving average. You're close to dropping below the 200-day or the 40-week exponential moving average with a pretty bearish candle on the lower close. Looking at the 3 green arrow chart for Apple, you can see we do have 3 red arrows, and the MACD is rising. The stochastic still easily oversold. Looking at the 2-line version, we are below the 50-day moving average and still easily below the 8 and 17, and for that matter also below the 200, though the MACD looks to be rising. So it looks like most of the bearishness has occurred. We are above the green cloud. Remember, the S&P is not, so you are still above the green even if you are below the green and the blue lines up there. And you do have a weak bearish trend, but nothing too major. As again, like I said, you're still above that cloud, and we can bounce off of this and stay above the cloud. And so again, coming down towards some support in this area. Looking at the DMI, you can see we are still above 25 on the negative indicator and dipping our toe under 20, which can be a buy signal. We can bounce off of that when you got your toe dipping below there. And then finally the RSI and CCI kind of dipping their toes under bearish territory, but not really extending their stay down in those levels. The Bollinger Bands also, looking very, very similar. A little bit higher of a bandwidth, but again, out of the lower quartile, but not quite bullish, not showing bullishness. So when you're not bearish anymore, but you're not quite showing bullishness either, then typically the best thing to do is to look for some kind of iron condor setup. So selling the 145, buying the 140 on that side, and then selling the 170, buying the 175, trying to get a decent credit. You can see the credit that we got was $500 for 3 contracts. We got 3 contracts here, and again, a full position size, and then your break even ends up, those lines right there, my break even. So essentially, I'd have to get back outside of these Fibonacci retracement zones, the orange ones, since the beginning of the year. So the 78% is basically sitting right on top of my break even there, and then my other break even to the downside is just barely above these two 23. So we'd have to break through both, either side, which would mean either we're starting a new bullish impulse move to the upside, or we're done retracing and we're going back down to the downside with a directional move to the downside. So as long as we stay in between, we're not directional, we make money on this iron condor. And again, up to about half of what my risk is for a reward. Not bad for a relatively higher probability trade. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any other thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.